Hello everyone, I am Sunil Gabhawalla, Vice President, Bombay Chartered Accountants Society, and I am here to speak about the levy provisions under GST and how they impact the common man in a very simplistic language. I will spend around 10 to 15 minutes with you to take you through some of the legal niceties of the GST regime. GST, as we all know, has been implemented by way of a concept of dual GST taxation. What it essentially means is a concurrent taxation on a common base called supply by both the center as well as the states. The concept of supply is being discussed in one of the separate short education video series, but what I am going to talk about is the fundamentals of how this concurrent taxation works. And as a design principle, we decided that we will have to bring a concept of destination based consumption tax, which basically means that the tax has to flow at the location where the goods or the services are consumed. The destination based consumption principle would also enable seamless flow of credits and will permit a scenario where the buyer, irrespective of the place where he is located, is eligible for credits. This basically operationalizes the concept of one nation, one tax, wherein the state boundaries in a way become redundant in the entire regime. But because it's a dual GST regime, the state has a role to play. And that's where at the design stage, we had challenges around this. Either this could have been done through a document driven regime or a technology driven regime. And for various obvious reasons, the government chose that GST should be technology driven. We are seeing some unique problems as of now on the technology, but that's a separate topic by itself. I will not go into that. Let me just quickly present the unique solution which India presented, which is by way of a concept of integrated GST, IGST. So as a design principle, what we are told is that while the GST is expected to be a destination based consumption tax, the administration of the tax will be in the origin state, the place where the supplier is located, which we will loosely now say is the location of supplier. However, though the originating state might collect the tax would be collected as a trustee on behalf of the consuming state, that is the destination state. And to define what is the destination state, we have elaborate place of supply rules. So, ladies and gentlemen, make no difference, IGST, a unique, exciting concept to take care of seamless flow of credits and ensuring no blockage of working capital, works on a pivot of two important principles, location of supplier and the place of supply. And the objective to ensure full flow of credit is achieved to a definition of something known as intrastate supply and interstate supply. And what we'll now do is take up some scenarios to understand this concept of intra and interstate supply and cross utilization of credits, and understand how a product which is imported into the country ultimately finds its tax base in the state where the consumption happens, irrespective of the number of states involved. What we'll do is we'll start with a case of an importer who is in Maharashtra. When he imports the product, we are told that imports would be liable for IGST. If it's a product, the IGST will be collected at the time of importation along with the customs duty. If it's an importation of a service, there will be a reverse charge mechanism and IGST would be applicable under the reverse charge mechanism. Any supplies which are originating and ending within the same state, which we will now say is intrastate supplies, would be liable for CGST and SGST. So, the importer in Maharashtra, when he sells locally within the state of Maharashtra, there will be a liability towards CGST and SGST. Now, this importer is in a very typical type of a scenario where he has to pay a collection of CGST and SGST as output taxes, but he has a lot of IGST credits which are accumulated on account of imports. And that is where the GST regime permits for a cross utilization of credits, and the IGST credit on imports can be immediately, without any conditions, be adjusted against the CGST and the SGST. When I am saying without any conditions, it's of course subject to the priority of utilization, but otherwise the credit is available, and in that sense, we will find that importers are no longer stuck with refund claims which as of today they are, like SAD refund claims. And that is what the entire GST regime tries to bring. The second buyer in Maharashtra then goes ahead and tries to sell the goods to somebody else in Madhya Pradesh. Necessarily, the location of the supplier is in Maharashtra, the place of supply being in Gujarat, because the consumption is in Gujarat in Madhya Pradesh in this example. The transaction will be treated as an interstate supply and will be liable for IGST. So again, he has a scenario of IGST as an output tax and a combination of CGST and SGST as credits. Again, a cross utilization is permitted, and thereby what he will do is he will utilize the CGST and the SGST to pay IGST. Again, there is no blockage of funds. As of today, there is a blockage of funds in terms of C-forms and the inverted rate structure. All of that is thought to be done away with this concept of high GST. Thereafter, when the Madhya Pradesh buyer who has bought the goods from Maharashtra sells it to a final consumer in Madhya Pradesh, he will again charge C plus SGST, and when this C plus SGST is charged, finally the SGST goes to the Madhya Pradesh government and the CGST, which is the central component, goes to the central government. When we look at this entire process, what we ultimately therefore find is, irrespective of the origin of the product and the number of states through which the product is moving, the tax, the state component of the tax ultimately goes to the state where the product is finally consumed. And in that sense, this actually takes care of various scenarios, no documentation, no refunds, no blockage of funds. And in that sense, it's a very interesting and a good concept, an innovative concept which we tried to bring in. Now, while we are looking at all these cases, we found a scenario that you could buy the goods in Maharashtra and then branch transfer it to some another state and sell the product from another state. With the dual GST concept, this could have resulted in a lot of blockage of funds and breakage of the credit chain. In order to avoid that, what we are told is interstate branch transfers will be liable for IGST, and this IGST essentially will enable a free flow of credit from the originating state, that is the branch transferring states, to the state where the goods are being received. Again, after the branch transfer, when the Gujarat, there is a local sale, in that case C plus SGST will be charged, and the IGST charged on the branch transfer will be available as a credit. Finally, we are told exports will not be liable for any taxes. In fact, we are given a zero rating concept, which means that all the corresponding input credits will be available back by way of a refund. On this point, there is a concept of letter of undertaking to be given, and there's a little bit of a paperwork involved in it, and there's a separate video which will be addressing that aspect. So this, according to me, is the broad context in which we have to look at the entire provisions of the GST law. And to enable all these provisions, we have the CGST Act, we have the SGST Act, and we have the IGST Act. Because we also have union territories without legislature, we have something known as the UTGST Act, which we can more or less similarly use as the SGST Act. And that takes me to the broad levy provision, which is section 9(1) of the CGST Act. Similarly worded provisions exist in the other sister acts. I will not take you through all of them. And when you look at the levy provision, what are we told? We are told there shall be levied a tax on all intrastate supplies of goods or services, or both, and therefore we are in a way doing away with the distinction between goods or services, except on supply of alcoholic liquor for human consumption, because that has been outside the purview of GST, on a value which is determined under section 15 and at such rates not exceeding 20%, and it shall be paid by the taxable person. So these are the key ingredients which come into the levy, and the most prominent of the ingredient amongst them, as far as the CGST and the SGST Act is concerned, is that it should be an intrastate supply. As far as IGST Act is concerned, it should be an interstate supply. And that straight away takes me into the concept of what is an interstate supply versus what is an intrastate supply. And as you can see from the chart which has been presented to you, there are two important ingredients in general which will determine whether something is interstate or intrastate. The first important ingredient is the location of the supplier. Where is the supplier located? Does he have a fixed establishment or a place of business? And that is the place where there will be a registration required for the supplier. Section 22 to 24 talks about the provisions of registration. That is also the place from where the invoice has to be raised, and that is also the place where the tax will be paid and administered. However, that doesn't mean that the tax will go to that state. What it basically means is this is the place where the administrative mechanism will be set up. The place where the tax ultimately goes is going to be the place of supply. There are elaborate place of supply rules for goods as well as services. They in effect define the place where the consumption takes place. In case of B2B supplies, that also defines the place where the credit can be claimed ab initio, and it also defines the state which will ultimately enjoy the revenue in case of B2C transactions. The place of supply is generally closer to the location of the recipient, though there are various exceptions, and in a video on place of supply this can be dealt with separately. But in the levy provisions, what we are talking about is understanding this connect between the location of supplier and the place of supply. And when we look at this connect, what we need to understand is that in a scenario where location of supplier and the place of supply are in the same states, we are told it's going to be an intrastate supply. And if they are in separate states, then it will be known as an interstate supply. But like all other laws, GST law also is subject to various exceptions. And here also we have various exceptions. And the first important exception is, we are told that supply of goods imported into the territory of India till the time they cross the customs frontiers of India will always be treated as interstate supply. And this is essentially to make sure that there is a uniformity of law for all imports happening into the countries. Therefore, even importation of services, we are told, will always be treated as an interstate supply. Again, because SEZ units deserve a special treatment, all supply of goods and or services to or by an SEZ unit or a developer will always be deemed to be an interstate supplier. And that is also one more reason where you have to make sure that the general test of location of supplier and the place of supply will become ineffective. These transactions will always be deemed to be interstate supply. Same way, any cross-border exports would also be always treated to be an interstate supply. So these are three important exceptions which we need to bear in mind when we are looking at the basic connection between the location of supplier and the place of supply. That takes me to an important question which has still not been addressed. How do you decide what is the location of supplier and the place of supply? And therefore, necessarily, whether you will be applying a combination of CGST, SGST or an IGST. And to answer that, we will take a very simplistic example of a chartered accountancy firm which has a head office in Mumbai and branches in Delhi and Ahmedabad. And we are taking an example where the Bombay office enters into an engagement letter with a client located in Calcutta. The work for that assignment is partially done from Ahmedabad, partially from Bombay and partially from Delhi. And the final sign off by the audit partner happens from Delhi. One thing which is very clear in this entire matrix is that the location of the client is unilateral, which is only Calcutta. And therefore, the place of supply is going to be West Bengal. But what is the location of the supplier? Is it Maharashtra, is it Gujarat, or is it Delhi? Because there is a partial work which is happening from each of these three locations. Or could it be also Calcutta, because a lot of actual work is going to happen from Calcutta. And this is where you have to go back to look at the definition of the location of the supplier. The location of supplier of service is defined under section 271 to mean a place where a registration is obtained if the supply is made from the place of business. If the supply is made from a fixed branch or an establishment elsewhere, which is an unregistered establishment, then it would be that location. However, if the supply is made from more than one establishments, in that case, you have to identify the establishment most directly concerned with the provision of the service. In the absence of all of these, you will have to go back to the usual place of residence of the supplier. Now coming to our facts which we are trying to highlight, it is very evident that the supply is not unidirectional. It is not made from one premises. There are more than one premises from where the supply is being made. And therefore, the tiebreaker test provided under subclause 3 becomes very much relevant. And what does that tiebreaker test say? It says, you please identify the establishment most directly concerned with the provision of the supply. Ladies and gentlemen, make no mistake. We are not told to split the invoices into multiple invoices from each of the locations. What we are told is, please raise an invoice from the establishment which is most directly concerned with the supply. And whenever we have a word of concern, this is also really a concern. Because what will happen is, you might assume that Bombay is the establishment most directly concerned, whereas the revenue authorities might assume Delhi is the establishment most directly concerned. So how do you decide what is the establishment most directly concerned? In international service tax and GST regime, we have multiple tests which have been laid down to define the establishment most directly concerned. While there is a very heavy emphasis on the contracting relationship, the multiple parameters like the actual work being done, the risk and reward, all of them will have to be taken into account. But yes, we need to bear in mind that the contracting relationship will have a fairly large prominence in this entire matrix. Coming back to our example, it's not only the fact that the audit engagement letter is signed off from Mumbai, there are also substantial activities being carried out from Mumbai. In that scenario, it is going to be easy to say that the establishment most directly concerned with the supply is Mumbai, and therefore the location of supply is Maharashtra. So In our example, we have a location of supplier which is in Maharashtra and the place of supply which is in West Bengal. Since both of them are in separate states, you end up paying IGST. You will tag it as a place of supply being West Bengal, and the tax will flow to the West Bengal government so that the client in West Bengal is in a position to claim the credit. Now we just change this fact matrix slightly and look at a scenario where just like the service provider is multi-locational, the client also is multi-locational. And we change it to say the client has a corporate office in Calcutta, a factory in Guwahati, and the registered office is located in Indore. And then we go back to understand how to determine the place of supply, which we say is closer to the location of the recipient. Again, we will use the similar analogy and we will now go to the definition of location of recipient of service provided under section 270 of the CGST Act. Again, a similarly worded provision like the location of supplier of services is there. So you will again go back to the tiebreaker test, because it will be very difficult to say that the supply of an audit service is consumed only by one location of the three. All the three locations of the client consume the supply of service of auditing, and therefore there is a scenario where you have a service received at more than one establishment. Your subclause 3 gets triggered. Again, you go back to the tiebreaker test, again look at the contracting relevance and say that predominantly the contract audit engagement letter was issued from Calcutta, and therefore Calcutta should continue to be the place of supply. The existence of a factory in Guwahati or a registered office in Indore should not change my answers on the place of supply. And that is how one will have to look at the entire mechanism of the levy. Now, when I am talking about all of this, one important question which definitely is going to come to everyone's mind is, are we therefore downplaying activities carried out by the Gujarat branch of the Chartered Accountant Office or the Delhi branch of the Chartered Accountant Office? And this is where there is this concept of branch transfer of services, which comes out of Schedule 1 of the GST Act, a deeming entry which brings about two important aspects. The first aspect is, a branch located in another state is treated as a distinct deemed entity as compared to the head office in another state. And therefore, XYZ Mumbai is not the same as XYZ Gujarat. So that is the first deeming fiction, and thereafter we have a second deeming fiction which says that there would be deemed to be a supply of a service between these branches which are located in different states. So essentially what will need to be done is a branch transfer invoice created for the respective roles and responsibilities carried out by the support units for the head office in performing this audit engagement. Similarly, at the client end also, the supply of the service has been received by one location, and that is for the benefit of multiple locations, and therefore the corporate office can be said to have provided a business support service to the respective branches, and accordingly there will be a dotted line created, and once these dotted lines are created, you will see that the objective of ensuring a free flow of credit is accomplished through this mechanism. That is the basic aspects of the levy which I wanted to bring out to you. I encourage you to look at various other series of short videos created by the Bombay Chartered Accountants Society. Thank you very much for being up to here. Thank you.